Welcome back. Well, the SGX Nifty is suggesting a big gap up in today's trading session, but there are a lot of stocks that we'll be tracking. So let's get straight to our top 10 stocks that we're tracking for you. Sonia, you go first. End of earnings season, but Hero MotoCorp will react to its numbers.
It will, and the numbers were below what the street was estimating, so I'm going with red over there. The revenue growth will look good because it was on a low base, so it was about a 53% growth. But the margin pressures continue, and that is because of higher raw material costs, higher other costs, freight, logistics, etc. that has hit them this time around. Now, if you look at the margins, 11.2%, the expectation was 12.1%. So in that sense, it's below street expectations. The good part is that they managed to maintain their margins sequentially. So Q4 also they did 11.2 and in Q1 as well 11.2. Now that's because despite higher raw material costs, they had some cost-cutting programs which they undertook, and because of that, they managed to bring down their overall cost-saving measures, judicious price increases, and the models that they sold more amount of premium models. So that helped them hold on to their margins at 11.2%. The management also said that the PBT for the quarter was impacted by lower other income that came from a mark-to-market loss to the extent of around 60 odd crores. So below street expectations, and brokerages have also gone ahead and cut their target prices. Okay,
so we keep an eye out on that one. Sonal, coming across to you, ONGC, how are the numbers?
Well, it was a mixed set, Nigel. While the revenues, they were they were higher than the estimates. EBITDA came largely in line. Margins were higher because of low costs that the company spoke about. Profits also higher than estimates, coming in at 15,206 crore rupees. Well, revenues, they were impacted by lower volumes this time around. So we were expecting growth of around 3% in terms of gas and both oil volumes as well. But the company saw flattish volumes both on the crude oil side and on the gas side as well. So it was flat on a YOY and on a quarter-on-quarter basis. Oil realizations absolutely in line with estimates at $108.5 per barrel, which compares with a poll of $108 per barrel. Motilal Oswal has reiterated the buy on the stock with a 27% upside. However, key risk according to them is sharp decline in oil prices, and also if there is continuation of windfall taxes. Considering that, remember that oil prices have fallen sharply from the top. Crude is at a 6-month low as we speak, so there could be some profit taking on the stock. Nomura also says that earnings have peaked out for ONGC as we speak. So yes, the stock could open in the green, but there could be some red after that.
Thank you very much for that. Big boy, LIC will be reacting to numbers. Yash is here with the analysis. Yash?
Well, Rima, I'm going with red as far as LIC is concerned. The story for LIC Q1 numbers was essentially strong premium growth, but weak internals when you go down the order. So net premium income, that grew by about 20%. Decent enough growth. The annualized premium equivalent, or APE, that grew by 28%. Again, decent growth. But when you come down the order, so value of new business, that fell by 75% on a quarter-on-quarter basis. I'm putting quarter-on-quarter because year-on-year number is not available. And though the previous quarter, that is Q4, had a seasonal advantage, but a miss of 75%, a fall of 75% cannot go unnoticed. Also, value of new business margin, that came down to about 13.6% versus 15.1% on a quarter-on-quarter basis. Again, a fell in the margin. Of course, seasonal advantage wouldn't help the numbers here, but still a fall from the previous quarter. The reason why margins fell was because participating products, their share essentially did not move much, and non-participating products again remained somewhere around the same point as per previous quarter. So, of course, the internals are weak, though the premium growth is strong, hence going with red for LIC.
Okay, going with red for LIC. Let's go across to Abhishek to find out more about Muthoot Finance. Abhishek, over to you.
Well, Sonia, it looks like the gold is not shining for NBFCs. So gold tonnage is down about close to 5% on a sequential basis. The net interest margin is perhaps at a 22-quarter low of 12.2% when compared to 13.74% in the previous quarter. The AM growth on a YOY basis is the weakest in 17 quarters, coming in at 7.7%, and the weakest in last 25 quarters in terms of sequential loan growth. Sequentially, the loan book is down about 2.3% quarter-on-quarter. The return ratios are also the weakest. ROA the weakest in 20 quarters, coming in at 5.6%, and ROE is the weakest in 22 quarters, coming in at 17.5%. Both in terms of NII and PAT, it's below our poll, and their subsidiaries, the housing subsidiary, that is both Belstar as well as the housing subsidiary, they reported deterioration in asset quality, which means the stock could be under pressure in trade today. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, hopping across to Manglam, he's joining in to tell us about Zee Entertainment as well as Sun TV. Morning, Manglam.
Good morning. So for Z, it was a top-down miss. The revenues were below expectations by a smidge. But, if you just take a look at the EBITDA, 236 crore versus a poll of 320 crores. And that reflected on the margins. And the net profit was nearly half of what the street anticipated. Why was that? Well, a couple of factors. One, ad revenues grew just around 5%. And that's because a lot of their free-to-air channels were taken off. And subscription revenue was down both year-on-year as well as quarter-on-quarter because of the impasse on the new tariff order. But at some point, it'll be interesting to see whether the dip is bought into or not, because one, they've increased their prices for Z5 by about 40%. Secondly, the merger with Sony will, of course, be something that, keeps a lid on the way the stock falls. And thirdly, valuations support the stock at 16 times one-year forward earnings. So those are a couple of factors I'll be watching out for Z. And on the other hand, for Sun TV, the numbers were much better than expectations. Revenues grew by around 47%. We had ad revenues grow by 41%. The EBITDA growing by around 54%. But the net profit was lower in its growth, primarily because of higher depreciation. The company said that in FY23, the ad revenue could grow anywhere between 10 to 12%, and the IPL media rights auction that came by would increase their revenues, annual revenues, by 300 crores and EBITDA by about 200 crores. So the stock opens up in the green, but here it'll be interesting to see whether that uptick has gets sold into or not, because ICICI Securities has said that the company continues to delay investments in originals for their OTT platform, and they've cut their EPS estimates by around 22 to 23% on account of higher amortization expectations.
Okay, thanks a lot for that. Well, Sonal, over to you for some more numbers.
Oh yes, I'm watching out for Apollo Tyres. I have Honeywell Automation and also JK Cement. Starting with Apollo Tyres, a mixed bag, so to say. Margins were down 70 basis points because of higher costs. Revenue, however, strong growth there, 30% uptick. EBITDA at 689 crores versus 566 crores, and profits were up 50%. Honeywell Automation largely in line with what the brokerages were estimating. Revenue of 15%, EBITDA growth of 4%. Margins, however, took a hit of 100 basis points, but that's largely in line with estimates. Profits grew by 11%. JK Cement, another mix that their revenue growth was quite strong on a YY basis, came in higher by 32%, which was led by a volume growth of 18% on a YY basis. But if you look at the margins, they have declined to 17.8%, which compares with 23.5% on a YY basis. Even sequentially, these numbers have reduced, leading to a profit decline of 15% as far as JK Cement is concerned.
Okay, thank you very much for that. Nimesh is also joining us, and he's going to tell us why we need to track Max Healthcare today. Nimesh?
Hi, Rima. So, brace for a very large block deal in Max Healthcare today. KKR, who's one of the promoter entity, is looking to sell its entire 27% stake via block deal today. The entire block is offered at up to 3.5% discount, which is between, say, 350 to 360 is the price band. Now, why I'm saying it's a large block, because even at the lower end, the deal size will be over $1 billion. That's big. And the fact that the promoter entity KKR is looking to sell the entire block, I guess that's going to be is going to have an overhang on the stock, at least in the start. But also remember, the other thing to watch out for would be, because KKR is classified as a promoter entity, the free float will increase big time, and hence going forward, also watch out for the weight of Max Healthcare going up in MSCI. So that's a different angle. But today, in the morning, there is for a very large block of $1.2 billion, where KKR will sell its entire 27% stake in Max Healthcare.
Thanks a lot, Nimesh, for joining and giving us that heads up. The stock ended with a cut of around 2.7%. Should be under pressure to kickstart trade. Well, let's do a quick recap then of all the top stocks that we are focusing on. The ones with positive news flow are ONGC, Sun TV, Apollo Tyres, Honeywell Automation, and JK Cement. While stocks with negative news flow include Hero MotoCorp, LIC, Muthoot Finance, Z Entertainment, as well as Max Healthcare. Well, that's about the top 10 stocks, but we'll also keep an eye out on ACC and Ambuja. Remember the street all through last week, there was a buzz that they could be getting approvals coming in. And the CCI approval, that's come in for Adani Group's acquisition of both those two, assets, ACC and Ambuja. The only step now that's remaining before they launch their open offer is the intimation to SEBI. So that's the only one that is pending. Morgan Stanley, they say that this is incremental positive because it was a bit of a regulatory overhang. Now that's out of the way, that's positive. They're awaiting the formal announcement with regard to the launch of the open offer. So we'll wait for that. In all probability, it should happen in the next 10 days or so.
Okay, well, thanks a lot for that. That's on ACC and Ambuja. Let's go across to Manisha Gupta. She'll give us a quick roundup of all that's been happening in the world of commodities. Manisha, good morning. Oops, Manisha, is my voice reaching you?
Oh.
Okay, I can't hear her, so we'll try and connect with her once again. Let's do one thing. Let's stay with the commodity space. We'll get you some opinion coming in from Cities Ed Morse. Listen in.
Well, it could go back above 100. There are lots of risks on the upside in the market that we can't ignore. Hurricane risk, I'd say, is the biggest of them all on the upside. And, we're not into the middle of the hurricane season yet. Things have been calm for the last several weeks in the Atlantic Basin, but the NOAA still is forecasting up to 20 named storms and 3 to 6 Category 3 or higher hurricanes, and that could knock out close to 2 million barrels a day out of the U.S. Gulf. It could go up, but I think without the weather, I think the signs of slowdown in economic growth, if not recession, are really dominating the story as far as oil is concerned.
In fact, let's get more on this story. We've reconnected with Manisha, and she's going to give us a complete roundup of all the action from the commodity markets.
Thank you for that. Well, yes, Ed was pointing out on the hurricane season, and we are in the middle of that, and there is a big expectation of a supply cut from there. But until that doesn't happen, there is pressure continuing in case of crude oil prices. Last night, we've seen 3.5% of a cut for the U.S. crude and 5% of a decline for the Brent prices. So we're trading very close to those 6-month lows in case of prices. The WTI actually saw a low of $86.60 in the overnight market. Some buying is what we've seen, but Asia continues to be under pressure because Chinese industrial production has missed expectation and is lower than as compared to previous month as well. OPEC also has cut demand expectations. Iran, as early as today, could accept the European Union offer to revive the nuclear deal. That would mean more Iran oil also coming into the market. And then there is a statement from Saudi Aramco saying that they are waiting for the government to give a go-ahead, and they could raise output to maximum of 12 million barrels per day. So higher supplies and not so strong demand, and the economic data seems to be weighing onto the crude oil prices right now. And that's exactly where what we have seen in sense of pressure coming in for the metal prices also, where you have seen 2 to 3.5% of a decline for commodities or metals like copper, iron ore, steel. All of these have seen a decline overnight.